Growth versus value investing sounds fancy, but it's really a simple choice about where you expect a company's money to come from. In plain language, growth bets on fast future profits, value bets on a bargain today. Growth stocks are companies that are expected to grow earnings and revenue quickly. Value stocks are those that the market price is cheap relative to their fundamentals. Both can work, but they behave differently in markets, and they suit different kinds of investors. Why this matters to you is simple. Growth often has bigger upside if you're right, but higher prices and more risk if the growth slows. Value usually comes with lower prices now and steady cash flow, but the upside can be more modest. Your plan should fit your goals, your nerves, and your time horizon. How to tell them apart in practice starts with 3 signals. First, growth signals. Is revenue growing steadily or accelerating? Are earnings moving higher? And does the company have a scalable business model? Second, value signals. Is the stock cheap compared with earnings or book value? Does the company carry a strong balance sheet and reliable cash flow? Third, quality signals. Does the company earn good returns on equity, and can it sustain profit with manageable debt? For growth stocks, look for rising revenue and earnings over the past 3 to 5 years, plus a clear path to more growth. For value stocks, look for low price multiples like a cheap price to earnings or price to book, plus a solid balance sheet and cash flow. Don't chase a cheap price if the company is failing to generate cash or has mounting risk. And don't pay up for a growth story with no real earnings or a weak moat. Here are practical steps you can apply today. Step 1. Define your goal. Do you want bigger gains if the market moves up, or steadier, calmer returns with less risk? Step 2. Build a simple screen. For growth, screen for steady revenue growth and improving margins, and tolerate a higher price tag if growth looks durable. For value, screen for low price multiples, strong cash flow, and a reasonable debt level. Step 3. Do a quick quality check. Look at returns on equity, free cash flow, and debt versus cash. Step 4. Decide on valuation. For growth, use a forward-looking measure like PEG, price to earnings growth, to see if the growth justifies the price. For value, use price to earnings, price to book, and cash flow yield to judge fairness. Step 5. Plan your entry. Use diversification and position sizing to avoid crowding into one idea. Consider dollar cost averaging to smooth entry and reduce timing risk. Step 6. Set a simple monitor rule. Review every 4 to 12 weeks. Has growth continued, or has the value thesis started to crack? Step 7. Keep risk in check. Don't overconcentrate in one stock or one sector. A small tilt toward growth or value is fine, but the total portfolio should reflect your comfort with risk. A simple blended approach is GARP, growth at a reasonable price. Look for solid growth signals, but only when the price isn't absurd. You're aiming for a middle ground, a company that can grow while you're paying a fair price for that growth. Here's a quick example to make it concrete. Suppose stock A is a software company with 20% annual revenue growth, improving margins, and a forward PE around 40, but a PG around 1.5. Stock B is a mature consumer stock with 3% growth, a strong balance sheet, and a forward PE of 12. A pure growth investor might like stock A, accepting the high price for the chance of big gains. A pure value investor might choose stock B for its cheap price and solid cash flow. A balanced approach could be to own a few shares of each, or to weight more toward B for stability and use some of the gains from A to rebalance. The goal is to have a repeatable process you actually use. Decide what you're aiming for, keep rules simple, and test your ideas on a small scale before committing more capital. Growth and value aren't enemies. They're different bets on how a business creates value over time. If you found this helpful, like this video, subscribe to the channel, and leave a comment with which approach you'd like to test first or with any questions you have. This is the kind of simple, repeatable strategy that can make investing less confusing and more practical.